Today you are going to learn my simple A+ model that made me my first $1,000. By the end of the video, you will have a consistent strategy that will finally make you a profitable trader. Starting off, we primarily want to trade this strategy from 7 a.m. to 11 a.m. New York session or London session, which is 2 a.m. to around 3 a.m. We want to trade during these times because price offers the most volatility during the open of a particular session. The second part of this strategy is identifying liquidity. Liquidity is important because it is the fuel of the market. Above certain highs and also certain lows, there are willing buyers or sellers who want to either take the market higher or lower. A lot of traders as well put their stops above these levels for bigger traders to target and then push price in the opposite direction. We are going to keep it simple inside of this model. So the main area of liquidity that we want to pay attention to is session highs and also session lows. So if we are trading New York session, we want to mark off the high of London and also the low as well. The same thing applies to London session. We want to mark off the high of Asia and also the low of Asia as well. So in this example, we are going to be trading New York. We mark off the high of London and also the low. And then we can see that London session was mainly inside of a consolidation. And then what did I just say earlier? Traders put their stops above and below these areas. So price uses the high of London as that liquidity and then moves inside of the opposite direction. That is what a liquidity sweep is. The third step of this strategy is identifying a higher time frame fair value gap or a supply and demand zone. We want to make sure that these levels are on the higher time frame, which is the 4-hour and the 1-hour, especially when we are day trading. Now, if you don't know what a fair value gap is, it is basically an area of imbalance inside of the markets. An example would be right here between these two candlesticks. There was a small gap. This is an area where price will come back and test and see if there are still active buyers that are willing to take the price higher. Now, fair value gaps can be a small gap like this one, or it can be a much larger gap as well. Now, supply and demand is another concept, similar to fair value gaps, but also very different. With supply and demand, specifically demand in this example, we want to identify an area where there is a lot of buying. For this, unlike a fair value gap, we're not just looking for a gap, but we're looking from where the buying pressure actually started from. In this example, this red candlestick would be the start of our demand zone. Why? Because after this red candlestick, we had an extension of all these green candlesticks. So when we get back to this zone, we expect price to respect it and then start moving higher because of the buying pressure that happened previously from this exact same level. Now, as you guys can see, we can have both or we can have either one. Sometimes I just trade off of fair value gap levels without the supply or demand, and sometimes I trade purely demand. Now, the same thing goes for supply zones. Supply zone would basically be the opposite, where we want to see a level where price sold off aggressively, and then we want to see the market come back to that level and reject the same way. Now, supply zones is the opposite, where we want to see price sell off from a level, come back to the origin of where that selling pressure started, and then reject again. Now, we can also combine fair value gaps and supply and demand zone. In this example, we had both a fair value gap, which is right here, along with a demand zone as well. We see that combining both creates a higher probability trade, as when we came in contact with this specific zone, price rejected very aggressively and we moved inside of the opposite direction. Once we've identified our fair value gap or supply and demand zone, now we need to see a market structure shift. A market structure shift essentially tells us that buyers or sellers are ready to push price inside of the opposite direction. We are done with the retracement and ready for expansion to new prices. We know that a market structure shift is happening purely by looking at structure being disrespected. So if we understand basic market structure, which is purely price was making a higher high and also higher lows, and then we come down, price disrespected this trend that it was in, making these higher highs and higher lows, exactly specifically at this point. So from this point and beyond, we were mainly looking for those sells. Now, at this point, we start to see that the market is starting to shift because of this big candlestick. And we can see it even better on the lower time frames. For our market structure shift, we mainly want to be looking for it on the 5-minute or even the 1-minute time frame. This is the 15-minute time frame, but we want to be even more refined to see that market structure shift on the lower time frames, because a lot of the times the move starts on the lower time frames, such as the 5-minute or the 1-minute. Now that we have our market structure shift confirmed, all we need is a break of candlestick, particularly on the 15-minute time frame. This is our entry model criteria. This whole time we've just been watching price, but we haven't entered that actual trade yet. Now, after we have this bullish break of candlestick inside of this example, we get inside of the trade because that bullish break of candlestick is the last piece of confirmation that we need that price is more than likely going to start going higher. Now, you do not have to wait for the full candlestick to close. If we go zoom in, we can see that this big candlestick was the bullish 15-minute engulfing. But if we would have waited for the close, we would have been in right here instead of getting in just a little bit lower right here. And over time, that does make a difference because some 15-minute candlesticks are bigger than others. So we do not have to wait for the close. We can get in exactly when it breaks above the previous candlestick. This is one of the most secure entry models that I have seen since trading. It's consistent, it's simple, and it works. So now that we have gone over the full strategy and its components, let's go over different pros and cons of this model before we then go into examples and different scenarios as well. So on the pro side, the first pro is that it is a higher probability model. You will be winning anywhere from 60% to 70% if you're doing things right. It can even be inside of the high 50s if you're doing things a little bit wrong, but still trying to follow it. Because of the entry model, because we're waiting, because we're following structure, it is more higher probability. It's a very simple model to execute and also very beginner friendly as well. It's not complex at all. We wait for very simple things and then we get inside of the trade. Nothing on the 1 minute, nothing complex, just super very simple. And then lastly, it works on almost every single asset that I've ever seen. So gold, YM, NQ, ES, oil, or even Forex, I've seen it work on multiple assets. Now, let's go over the con side. Now, even though it works on every single asset, because it is a higher probability model, it doesn't happen often on a particular asset. For example, this month, I've only traded this model 3 times on gold. One way to bypass this is by getting different assets to trade so that you can have more opportunity. If you don't, you only be getting 3, 4, 5 trades every single month. Next, this model requires a lot of patience. Like I just said before, it doesn't happen every single day on a particular asset. So there is a lot of patience that does go into it and seeing it form just because it is a little more higher probability. And lastly, it does not work well against the higher time frame direction. So when you're trading this model, you want to be trading with the overall bias of the market. Why? Because since we're getting in on the 15-minute time frame, we don't have time to be trading against the overall trend because our risk to reward isn't going to be right and we're not going to be getting our TB hit, because if we're going against the overall trend, price is more than likely going reverse on us. Different traders like 1 minute scalper or 5-minute scalpers, they can get that risk to reward. But with this model, it is better if you trade with the trend. So now that we've gone over the pros and cons of this model, let's walk through different scenarios so that you guys can see it and put it all together inside of the live markets. All right, so let's get into a couple of examples with this exact model. So first we have our time. During this time, like I said, we will primarily be trading New York or London session. Inside of these examples, I'm going to be trading New York, and I will show you guys an example with London as well. But first, let's go turn on our sessions so that we can see what session we are particularly in. So to get the sessions indicator, you want to go to indicators and type in sessions. Once you type it in, click on trading sessions or sessions. This will allow you to see the different sessions there are. So on this particular example, the white is Asia, the yellow is London, and orange is New York. First, we want to identify where is liquidity resting at. So we mark off London low, which is right here, and we also mark off London high, which is up here. So this is our area of liquidity, just like in our example. And what is our next step? We wait for that liquidity sweep. So during the first hour of New York, we're then waiting for a liquidity sweep of either London low or London high. But remember, since we are going inside of the higher time frame direction, we want to be looking for buys here. So we're waiting for a liquidity sweep right below London low. At 8:30, which is Wall Street open, we get the liquidity sweep right below London low. Next, we want to go to the higher time frame and identify higher time frame zones. So we have right here a fair value gap on the higher time frame, which is the 1 hour. And if we go to the 4-hour time frame, we have a demand zone, which is right here. All that put together, we want to go to the lower time frames now and identify, is there actually a market structure shift? So for that, I go down to my 1-minute time frame and I'm looking. So after we got the sweep at 8:30, we can see that the market continues to go lower until right here. Right here, if you guys look very closely, we started breaking and the market started to what? It started to shift. This was our last point. We break above this point, market shift. Market is shifting. So since we've seen that the market is shifting now, all we wait for is a 15-minute break. I like putting my stop loss here. I could put it under the wick, or I could put it under all the way below this candlestick right here. If I want to be very conservative, sometimes I just put it right here under this wick if I don't want such a big stop. And I'm just targeting right above London high or even further. I'll make a different video on trade management and everything like that. But in this video, we're just going to keep it simple. We're going to go for a 1-for-2 risk to reward. So in this example, we see that the trade plays out just like that. All right, now let's go through the same step-by-step process, but now let's go through it with gold during London session. So in this example, we can see the same thing. First, we want to identify where liquidity actually resting at. So we go here and we already have our sessions marked off. We have Asia in the white, and then we have London, which starts off inside of the yellow. So Asia, we primarily want to mark off what? We primarily want to mark off Asia high and also Asia low. After we mark off the high and also the low of Asia, we wait for those first hours of London for a sweep. We get that here. Since the market on gold is primarily bearish, we want to see that liquidity sweep of the highs of Asia so that we can go to the downside on gold. So inside of this example, next we want to see the higher time frame fair value gap or supply or demand zone. Here we have both. We have both a supply zone and a higher time frame fair value gap. So which one do we wait for? Do we wait till price all the way up here and for price to respect and tap into the supply zone, or do we just get in based off of the fair value gap? For me personally, this is how I see it. If we are inside of a fair value gap, which is this, and we respect about 50% of that fair value gap, I'm going to get inside of the trade. Even if we do not touch fully, if we go a little bit inside of the fair value gap, 50% at least, and then we reject, I still look at that as valid. So here we are about 50% in to this fair value gap, which is right here. So next things next is seeing that market structure shift. If we go down to the lower time frames, we can see that after we've tapped in 50%, we see that the market started to shift and break structure lower. This was the last high, and then this was the last low that was created on the 1 minute time frame. We shift below this, signaling that there's a change in the market behavior. That leads us to get inside on the break of candlestick entry off of the 15-minute time frame. We put our stop loss right above this last high. We could put it at the wick, but we're going to put it right on top of this high. And we are going to target a simple 1 to 2 risk to reward. We're already in profit here, and the trade cleanly plays out. Everything put together, liquidity sweep, tap into higher time frame fair value gap. We didn't touch the supply and demand zone fully, but we did tap into the fair value gap, and then the entry on the 15-minute with the market structure shift. Now that I've shown you guys a couple of examples of this model actually working out, I'm going to show you an example of where this system did not work out. This model is still very high probability, but like I said, it's 60% to 70%, and sometimes even 50%. So with this model, there's going to come losses. So I'm showing you guys this loss so you're not afraid when you do take losses trading this model. So during the first hours of New York, what do we see? We want to mark off our liquidity first, which is London high and also London low. So right now we are kind of still inside this range. We want to see a break of London, then a move higher. So right there, even though the candlestick is already printed, if you were trading this live, it would have been so very different. I know because I traded this exact system on this exact day, and I saw this happen live right in front of my face. So after we got the liquidity sweep of London low, we did get a rejection, right? We go to the lower time frames, and we see that the market actually did start to shift here as well. We started to break higher. We go to the higher time frames, and then we are looking for what? A fair value gap, right? So after the sweep, even though this candlestick is already printed fully, there was a huge rejection off of this 1 hour fair value gap. So based off of all this is all I need to see. We're making higher and higher prices thus far on gold. Even though we did sell off just a little bit here, we're still respecting on the higher time frame. So with all that being said, I got inside of the trade, and you would have gotten inside the trade too right here. It broke above this candlestick, even though it was just a little bit, and then does what? It rejects and goes lower, stopping all of us out of this trade. This is an example of a losing trade. Now, you could say what you want. Okay, was structure really bearish? Was structure really bullish? And a whole bunch of other things. But I'm here to tell you, like, losses like this happen not all the time because it's higher probability, but like once in a while you're going to take a loss like this in best sort of conditions, just because it's all probabilities. So we broke above here, and then it went straight to our stop loss. What do? We go on to the next trade. All right, I'm going to be showing you guys 2 more examples. So this example happened on ES. So on this particular day, we're looking at the same sort of thing. We mark off our areas of liquidity. We mark off London high and also London low. With this strategy as well, I forgot to say this before, but if you trade New York session, you can also mark off Asia low. Because if Asia high or Asia low still hasn't been taken out, particularly in this example, we're looking at Asia low because it hasn't been taken out, we can still target that area for price to then move higher. So we mark off all of these areas. We then go to the 1 hour time frame. And what are we looking for? We are looking for demand zones, particularly because we want to see buyers step in because the overall narrative on EA has been bullish. So we then go to the higher time frame. We mark off our just right here. So in this example, there was no fair value gap. There was just this demand zone. I mean, we did have the fair value gap, which was right here, but price failed to actually touch the demand zone. This is an example where price actually touches the demand zone. So after price does that, we then go to the 1 minute time frame. And this whole time we've been pushing pretty solidly to the downside. Now we did have this market structure shift right here, but we did not have the 15-minute break of candlestick. So like if you were trading on the 1 minute time frame, you see this liquidity sweep right here. You then see the break. Maybe you use something else. You would have gotten in right here thinking that price is going to go higher, and then you would have gotten stopped out. So now we're just continuing to wait. We're looking, okay, there we go, right here. Right, the market structure shift above this level. We disrespect these sellers. Next, we just go to the 15-minute and look at this big candlestick. Look at this big candlestick after we took out liquidity, tapped into our demand zone with a whole bunch of buyers. We have this big candlestick right here. We put our stop loss right below the candlestick low, and we're targeting a simple 1 to 2 risk to reward. Right now, we're just going simple with the risk to reward and keeping it fixed just because we want to be consistent. So we keep it simple. We get in off the 1 to 2 risk to reward, and price goes straight to our TP. Okay, here's another example, and this is the last example, which happened on US 30. I'm showing you guys this example because it's a little bit different. So inside of this example, we had this big demand zone on the higher time frame, as well as if we go to the 4-hour, we also have a fair value gap, which is down here. So let's just run through the whole entire day. We're on the 15-minute. We first open up inside of New York. First, we see this big expansion move to the upside, but we did take out London high, which is right here. And we have to mark off London low as well, which is down here. We do have to mark off as well Asia high and also Asia low. I almost skipped these steps, but I have to remember. So myself, sometimes I skip steps. I don't go in order all the time, but you guys can see it's the same process. So during New York, we took out London high though. So this is an example where we take out London high, but Asia high is still intact. So after we take out London high, let's see what happens next. We get a sweep all the way down to London low. After that, what am I looking for? Go to the higher time frame, and we see that we did have this demand zone. Now this demand zone has no gap. We did have a gap, but it's kind of did already get filled, but it's still a valid demand zone on the 1 hour. So next we just go to the 15-minute and we're waiting. So next we go to the 1 minute and we're waiting for a market structure shift, which happened right over here. Right over here, this was the market structure shift. And now we're just waiting. Minute break of candlestick, which happened right inside of this area. We get in off of this 15-minute break of candlestick. We put our stop loss right below this candlestick low. And now we're targeting a simple 1 for 2 risk to reward. We see price go straight, and then we end up hitting it. Now we were kind of above a little bit, a 1 to 2, but you guys get the point. This was another trade example that happened. This one was a little bit different. We still had Asia high liquidity, but we did take out London and reject. We then went to the lows of London, and then we went back up to take out Asia high. So liquidity can be different every single day. It can form differently. It can have these ways that it is taken out, and you just have it when it happens and then move accordingly. So that's it for this video. I hope you guys really enjoyed this whole entire video on this specific model, and I hope you guys can use it during this week and see it on your particular assets that you trade to achieve consistent profitability. Let me know in the comments if you guys have any other questions or any questions, and I'll definitely get back to you. That's it for this video, and I'll see you guys next time.